Hello, everyone. I'm Carlos Carnicero Urabayen. Welcome to another Future is Blue video talk, the space promoted by Funcas and Agenda Pública. And today we're joined by Raymond Torres, Funcas Europe Director, and we're going to cover the latest report by the IMF and what it means for Europe and for the world as well. We'll see that in a moment. So, Raymond, thank you for joining us. And let me start by asking you, in general terms, what's new in this report? If I understand correctly, there are some positive aspects. The shock, the fund says the shock is not as bad as it anticipated in the summer. Is that correct?
Indeed, Carlos. Hello to everybody. And indeed, the IMF has revised its economic projections. They are slightly better in the sense that they do not get worse. The world economy continues to decline significantly. In fact, it's the sharpest contraction since the Second World War, practically. And there is a recovery for next year, which is projected, but not enough to, in a way, recover all the ground lost. So I think that's more or less the picture. So slightly better compared to the previous projection. However, I think that's really new in a way. The IMF emphasizes a number of very significant risks, which were already identified before, but now there's much more emphasis on those risks. The first one is that there is a lot of discussion about the risks in emerging economies. They don't have the same room for maneuver, the fiscal instruments, monetary instruments to respond to the crisis. They don't have the same institutional setup, health systems. And in addition to that, some of them are heavily indebted. If you exclude China, the picture is really very serious in much of Latin America, many African countries as well, oil-producing countries. So we are talking about a very significant risk of, in a way, debt failures and economic failures in those countries. The IMF has more than 80 programs, 80 countries with a program, a restructuring and adjustment program in more than 80 countries, mainly emerging and developing countries.
So the gap is widening between the advanced economies and the developing countries. So the virus is proving more damaging to those with less resources than others that are more developed.
Indeed, I mean, it's not that the fall in GDP, the contraction of the economy is actually a little more in advanced economies than in emerging and developing countries in size, but a reduction in output in developing countries is a lot more damaging because of the debt issues and because these are countries where population continues to grow, and therefore it entails a very significant cut in living standards in those countries, which are very, very poor. So the IMF also projects, as well as other institutions, an aggravation of poverty in the world, and particularly in those countries. So that's the first element for which there's a lot of emphasis. Another element for which there's a lot of emphasis, and I think it's new in a way, is that the IMF identifies the risk of what it calls scarring effects. In other words, long-term impacts of the crisis. If you want, what happens is that in the first stages of the crisis, the countries reacted by providing short-term work schemes, liquidity loans to enterprises, and this actually worked. It facilitated, in a way, it cushioned the impact of the crisis on the economy. But now we are entering a new phase where uncertainty continues to be very significant. And those short-term work schemes and enterprise liquidity loans will not be enough. Will not be enough to avert long-term exclusion from the labor market, long-term unemployment, and also enterprise failures, enterprises becoming insolvent. And it's not with new loans that you're not going to solve the problem, actually. So you need a new approach. And that second risk, these long-term scarring effects, is very much, I think, welcome in the report, because I think this is very real, not only in the world, but in the world economy, but also in particular in Europe.
Raymond, let me ask you, let's focus on Europe. In fact, numbers are better. Still, this is a terrible and the worst crisis since the Great Depression, but still numbers are a bit better. In fact, for the Eurozone, the fund is saying that the shock is going to be 1.9% less for the whole Eurozone, but still for Spain is an exception, and it's forecasting a decline of 12.8%. So Raymond, again, I need to ask you, what's so special about Spain so that the situation is so damaging?
There are three factors. The first one is that the pandemic has hit Spain more than other European countries. When you look at the number of infections, if you look at other health indicators, it has been stronger effect, despite the very strict lockdown measures which were adopted back in March, April. The second reason is the very significant size of tourism and high contact sectors, in particular services sectors in Spain, so vis-a-vis other countries. So Spain has about 28% of its economy. It's concentrating in those tourism and high contact density sectors, compared to about 22-23% on average in Europe. And the reason is that the room for maneuver in Spain to counteract the impacts of the crisis has been less. In other words, if you look at the size of the fiscal packages as identified by the IMF and as compared by the IMF, Spain has spent less on supporting the economy than other European countries. And these three factors together, I think, contribute largely to explain the very serious contraction in the economy during the second quarter, even though the second half of the year seems better and there is a recovery which is underway, but very bumpy because of the new infections, and very bumpy also because of the new restrictions to mobility which have been implemented recently.
Now, moving on to the recommendations that the fund is sharing broadly, it's warning about the risk of premature removal of support and of access to liquidity, but interestingly, is not recommending, as it used to embrace austerity, considering the high level of public debt that we're already seeing in most economies. So is that there's been some lessons learned from 10 years ago, or this crisis is different, therefore the fund is saying austerity is not the answer, or what's your reading of that?
I think both are true. The lessons have been learned from the past crisis, in particular the global financial crisis and the sovereign debt crisis that followed. The fund now sees much more clearly that there is a link between austerity measures and then a financial crisis. So if you push very hard on the austerity button, what happens is that you then have a lot of bank losses, which trigger a reduction in credit to the economy and therefore a new slowdown. And I think this is now very clear. And this is why it's one of the reasons why the IMF recommends a very cautious approach to relaxing fiscal stimulus. It rather recommends a different type of fiscal stimulus, taking into account what I mentioned before, the risk of bankruptcies and the risk of long-term unemployment. The second lesson learned is that this is new in a way. The fund has very clearly seen that this crisis is different from earlier ones, from all earlier crises that people remember of. And this one is a crisis which, in a way, paralyzes the economy and requires some sort of bridge funding, bridge support in order to make sure that the productive system continues to exist and survives to the health shock. And this has been, I think, properly identified both by the IMF, but I think also in Europe by all actors. And I think that it's a wise recommendation not to withdraw the stimulus measures at least for another year in 2021, even though I think the stimulus measures need to be calibrated and refined as the crisis goes.
You said calibrated and refined, for instance, considering what sectors need to be supported more than others, considering what's the contribution, how productive they are for the economy of tomorrow. You're thinking about those kind of.
Yes, indeed. I think it has to be calibrated in the sense that instead of just simply providing liquidity to enterprises, it needs to be refined, this instrument, and distinguish between enterprises that are viable vis-à-vis those that are non-viable. Those that are viable will require sometimes, again, liquidity, but sometimes capital injections in the enterprise. So this is different. In other words, you need to refloat the enterprise has too much debt, and the debt has to be converted into equity or restructured. And this is deserved by the fact that those enterprises are viable. And there may be many of those in the tourism sector. You may have, for example, particular hotel chains, which are viable in the long term. There will be at some point a recovery in tourism. And therefore, even though those enterprises are heavily indebted, well, those capital injections will help them survive and continue to exist in the future. In non-viable enterprises, you need a different approach. Just providing more loans, more liquidity will not solve the problem. You need a restructuring of the enterprise. And this has to be embedded into fiscal policy. Another reason why you need to calibrate fiscal policy is that simply provide short-term support to retaining jobs in enterprises, the short-term work schemes like Kurzarbeit in Germany, ERTE in Spain, chômage partiel in France, Cassa Integrazione in Italy. This is, of course, has been extremely important and useful. And this, as you know, has helped reduce the impact of the crisis on unemployment vis-à-vis the US, where the increase in income has been very abrupt, in fact. But yet, from now on, those support measures, those job support measures need to be refined and recalibrated in order to, for example, make them conditional on people participating in training or facilitating the fact that people may have to move from one sector, one enterprise to the other. And because when people are there for many months, there's a risk that, well, they may be sitting in a zombie enterprise. And it's not wise to continue to support a job in an enterprise which, in a way, exists only artificially.
So I think this crisis is very much about reinvention and seeing definitely the world is changing, the economy is changing. So definitely we need to have a look at what sectors are being supported and what kind of incentives we're giving to people to train and learn for things that are going to be relevant in the world after coronavirus. Raymond, thank you. I think this was very interesting. I'm sure there will be more opportunities to keep commenting on this severe crisis and the responses we're seeing from policymakers. So thank you and take care.
Thanks to you. Thank you very much.